Let's go ahead and get started. It's a couple minutes past our start time. So full disclosure, everybody in the attendee list and to the panelists, more importantly, we're recording this. So we'll make this available across the necessary channels afterwards, but this one goes down for the record. So of course, tonight's topic is lending during lockdown, the rapidly changing environment of real estate finance. So what we talk about tonight may totally change by tomorrow morning at 8 a.m. That was the running joke a couple minutes ago. This is the virtual Long Beach for investors by investors meeting. Normally we meet on the fourth Thursday of the month at the Long Beach Public Library in downtown. Of course, due to unforeseen circumstances, we're having a virtual meeting, a webinar on Zoom today, and hopefully you guys enjoy it. FIBI is all about, if you haven't been to a meeting before, it's a networking organization that provides content and networking opportunities for real estate investors, and we're really focused on providing good information with no sales pitch. So we're just going to get right into this. We have a great panel of experts on lending from a variety of different industry, well, at least parts of the lending industry. And without further ado, I'm just going to ask everybody to introduce themselves and explain a bit about what part of the real estate finance industry you spend most of your time. And we'll start with David Guevara.
Hey everybody, I'm David Guevara. I'm with Momenta Capital Group. I focus primarily on smaller multifamily and commercial transactions from anywhere ranging from $1 million to $7.5 million, typically in the local nationwide market.
All right, and Brett Lightner.
Hi everybody, I'm Brett Lightner. I'm with Caliber Home Loans. I manage a local branch of Caliber Home Loans in Manhattan Beach. I'm an originator here as well. And we do almost all things residential, 1 to 4 units, owner-occupied, rental properties, FHA, VA, all the different government programs, bond loans. And that's my day job, as I call it. And then the other hat that I wear is I do apartment finance, bridge finance. I used to do construction loans, so we'll talk more about that. That's about it.
All right. And Andrew, Westling.
Hey, good evening, everyone. Good evening, Anthony. Thanks for having me. My name is Andrew Westling with Walker Dunlop. We are a national commercial real estate finance company. Our company is Fannie Mae's largest lender nationally for multifamily finance. Last year, we did $32 billion in total debt transactions. My team of 4 here in Los Angeles, over the last 5 years, we've done about $1.25 billion, about $250 million annually. We do a lot of multifamily finance, but we also do all asset classes: retail, office, industrial, hospitality, and we are a correspondent for about 50 life insurance companies nationwide as well.
Awesome. And we have Matt Owens. He's a co-host here. He's also deeply involved in the lending industry. Matt, maybe you want to do a quick intro for yourself as well.
My name is Matthew Owens. I'm a CPA here in California. I lend a lot on the Midwest. I also flip about 5 to 10 houses a month out of state as well. Do some smaller multifamily value adds, some short-term rentals, and help run FIBI. So, and Andrew, your titles are so much better than mine. I love them. So it's a perfect opportunity right now. So, but yeah, it's very interesting out there right now. We'll see how this all plays out.
Awesome. And last but not least, David Weiner.
Hello, everyone. David Weiner with Trillion Capital. We're a hard money lender out of San Diego. We make loans primarily fix and flip. We do bridge loans, some multifamily and construction. Shout out to Karen Moore, you probably know her, and Mike Manji, who are operating in the LA region mostly. And yeah, thanks for the opportunity, guys. This is nice to get in front of people, and thanks for everybody for staying in and watching us.
All right, thanks so much for all the panelists for joining us tonight. So first off, it seems that almost daily we're hearing new and sometimes conflicting information about changes in real estate financing. About a month ago, the Fed slashed their overnight funds rate to 0, and the 10-year Treasury remains below 1%, yet mortgage rates rose and some lenders stopped lending entirely. What's happening in your space and why? And let's go to David Guevara first.
All right, so I focus primarily on, especially in this local market, I focus primarily on portfolio banks, which means essentially the big difference in, Andrew will get into what he does a little bit more in a minute, but there's agency debt, which is nationwide, backed by the federal government and sold on Wall Street, pooled and securitized, like Fannie Mae, Freddie Mac, and CMBS. What I focus on primarily are local banks, a lot of them large banks that you've heard of, a lot of them small banks that you've never heard of, that have multifamily lending programs for smaller multifamily properties, generally 5 to 15 minutes in this local area. And so those particular programs, what we've seen in recent weeks is several banks have actually canceled all the deals that they had started before this, and completely halted acceptance of new applications. And then we've also seen other lenders, rather than cancel their deals, they've changed their underwriting requirements, requested additional reserves be held on deposit after closing. We've seen limits to, increase of the minimum debt coverage ratio, decrease of the maximum loan to values, just different changes, increasing of the underwriting rate, which we can go into a little bit more if you guys would like, which is essentially just a rate that when we're looking at the debt coverage ratio, we use a higher rate than what the actual note rate is going to be, just to create an extra level of conservatism. So banks have kind of just gotten a lot more conservative and have looked at these deals with a lot more care than ever before, or not than ever before, but than they have in the last decade, certainly. And in many instances have stopped lending altogether. So where we were doing rates or doing loans at a rate of 3.2, 3.5, right around there before all this, now we're looking at rates, in the low mid fours to the high fours in some instances for the same exact loan that's actually being underwritten more conservatively. And the reason for the tightening of the underwriting criteria and the increase of the rate is primarily just due to a different amount of risk in the market. When lending on multifamily properties, if there's a risk that tenants are not going to pay their rents, you have to look at it as a bank and say, if there's a risk that tenants are not going to pay their rent, then our loans are potentially at risk. And so we need to adjust that risk premium and for the time being, increase the rates to essentially do two things. New loans moving forward, we want to take into account the new risk in this market. And then in addition, we don't want to be lending so much. And the easiest way to not lend so much is to make ourselves less competitive. And so that's what a lot of the local banks have done in an effort to shrink their pipelines and minimize the amount of new loans coming in. So that's most of what I've been seeing in the rate environment.
Out of the lenders that you typically work with, what just general percentage would you say have stopped lending entirely?
There's probably, I would say 30 banks that lend in this local market, the, Orange County, Southern California, especially coastal, probably 30 banks. And of those, the ones that get the majority of the business, I could probably say 10 of those 10, three have stopped.
Sure.
Yeah, 3 or 4. So the other ones have just become a lot more conservative. The main thing that everybody wants to see right now is reserves. All the lenders just want to see a lot more reserves, and a lot of that has to do with the fact that immediately when the news broke of this, they got a huge influx of forbearance requests from clients, and so when the banks are receiving a lot of inquiries for forbearance, they immediately look at it and say, well, we thought they had money in the bank, but if they're asking for help right away, maybe we need to make sure that they have a lot more money in the bank. And so, or at least for the time being. So that's a lot of what I've been seeing.
How much do you think this is a knee-jerk reaction versus the new standard? Because you can see the mindset shift in a lot of lenders immediately right now. And, I just got off the phone with David Coe, which a lot of you guys know, and he was saying that one client, they were requiring $2 million worth of reserves, or I'm sorry, 50%. It was basically $2 million of total reserves because they were requiring 50% of the loan balances across his other 4 loans in order to get his 5th loan. I was like, I'm like, not even, payments, 6 months or a year of payments. It's half the loan balance. I was amazed, so
yeah,
what's your thoughts?
That's pretty steep. I haven't been seeing it that much. Typically what I've been seeing is anywhere between 6 to 18 months of principal and interest payment reserves. and different banks are handling it differently. On the portfolio side, a lot of banks are using those reserves to pay your first 6, 12, or 18 payments. And so essentially you're just paying them up front at closing if it's a purchase transaction or even a refinance. On the agency side, Andrew can go into this a little bit more in detail, but they tend to be holding that in an escrowed account and then releasing the entire lump sum later and still requiring those payments in between. So everybody's kind of handling it differently, and it's been difficult to keep track because the changes have been often, and you know, each lender's had a different way of looking at it. But yeah, as far as reserves, definitely reserves have been required in a much greater scale than before. That particular example is a little bit more than what I've seen, but some banks are extremely conservative about it right now.
All right. So Brett, what's going on in the residential space?
Residential space has been kind of unique because what happened was pre-coronavirus in February, rates dropped. So there was this huge influx of refinance and purchase transactions, which teed up for a record March. So our company had a record February and then a record March. March, the company did over $2 billion in funding of residential loans. And then the rates dropped all the way up until March 6th, and there was a record number of rate locks. So what happened was it stressed the system. Coronavirus, we hadn't been on a lockdown yet, but coronavirus was a real thing. And then rates went up. So rates, the bond market sold off on March 7th or March 9th, and rates went up. And what happened was we had a record number of loans on the book. So ended up closing out March in excess of $2 billion, and the total number of locks that we have, we will break $3 billion for the month of April. It'll be our biggest month ever.
Oh, wow.
And it'll be, you know, historical low interest rates. So what's happening for us is it's just causing a little bit of a bottleneck. Everything is taking a little longer. And the other thing, of course, is that there's new lender overlays, guideline changes. A lot of our jumbo programs from the caliber, from our correspondent programs are pretty much gone. We don't really have a competitive jumbo program that we underwrite, that we service. We have brokered jumbo programs still, which are really good. We even have brokered loan programs with 10% down jumbos up to $2 million, right? I still find that amazing. Ask me tomorrow if we still have it, but we still have it today. And then the other thing is there's this thing called COVID overlays, and this is a temporary overlay that all borrowers' employment has to be verified almost right up to the last minute. So they have to sign an affidavit that their income has not been affected. They have to prove income right up to 10 days before the note date. If they're self-employed, we need to see actually in the form of deposits into their businesses or personal account. So there's a lot of additional steps. There's an additional layer of verification of employment right before closing. Where people are getting furloughed, they go into contract, whether it's a refinance or a purchase, and they think they have job stability, and 3 days before the close of escrow, they get furloughed. So that's what we're trying to be cautious of.
Got it.
And if somebody's in forbearance on their existing loan, we're not going to refinance them. Can't make your current payment, we're not going to give you a new loan.
That makes sense. So a cautionary tale for people that, you know, are looking for a free handout, for lack of a better word, right? You got to be really careful before you embark on some of these programs, whether it's forbearance or taking on new debt or disaster loans. We don't really know how that's going to affect you down the line. And that's a great example. Has LTV adjusted a lot in your space?
You know, less than you would think. The VA program is 0% down to $2 million right now. The only thing that's changed is the FICO requirement and the reserve requirement. So the FICO score was, I don't remember, it was in the 500s. Now it's in the low 600s. And you used to have 0 reserves. I think you have to have 3 months reserves. Okay. Don't quote me on that, but it's roughly. But for the most part, on the agency, Fannie, Freddie, Cubby stuff, the LTVs haven't changed. In fact, it's even easier to qualify because the rates are so low.
Wow. Okay.
As long as you're working, as long as you qualify.
Yeah, that's the trick, right? Okay, Andrew, Westling, what's going on in the agency and CMBS market?
Good question. So very different things. Let's start. The easy one is CMBS, commercial mortgage-backed securities. They've essentially been on hold with new originations since, I'd say, mid-March. And this is my opinion, but my gut says they probably won't be back in action issuing new debt until probably the fall, late summer, fall timeframe. Agency, Fannie Mae, Freddie Mac, and FHFA through HUD, very different story though. So what we saw in that market is, well, A, they're actively lending. We're actively quoting, rate locking, closing transactions on multifamily and all types of multifamily, although we are being, at least Walker and Dunlop, we're being a little bit more conservative and looking at student housing and some seniors housing. But what we saw is, and you kind of have to understand how Fannie and Freddie price their loans. So traditionally, there's the U.S. Treasury, the corresponding Treasury, so the 7-year, the 10-year, if you're getting a 7-year fixed or a 10-year fixed, and then there's a spread that's laid on top of that. So as the Treasury moves, spreads also widen and compact to get you all-in coupon. And when COVID first happened, what we saw was that there was a lot of liquidity drying up in the bondholders who ultimately buy these loans on the secondary market. And so immediately we saw Fannie spreads widen about 150 basis points. And then the Fed stepped up and said, we're going to start buying mortgage-backed security, specifically through Fannie. And almost immediately we saw rates come back, spreads come back about 150 basis points. So we are, from a rate perspective, almost where we were pre-COVID, maybe slightly wider. But, we rate locked a deal, a 10-year fixed deal on a mobile home community last week at 2.7%. And so, I've deals right now that we've quoted, higher leverage deals at 3.8 and 4%. So, that's still the norm. Like David said, and we'll probably get into it a little bit more, we are being a little bit more stringent on underwriting and reserve requirements. And so that means borrowers need to have more liquidity, potentially more net worth coming into transactions. We're being a little bit more hesitant on cash out, but it's still available. And that's what we're seeing sort of in Fannie and Freddie land. And then I'll just touch on life insurance companies too, because they're a little bit of a different story. So if you think about a life insurance company, if I have a whole life policy that I'm paying to Northwestern Mutual or to Prudential, they're collecting that cash, and then they have an obligation to go and invest all that money. So they have a lot of different avenues with which they can invest all the cash that they're sitting on, one of which is putting real estate loans out on properties. And traditionally, the way that they've sort of justified that is we will make real estate loans because they give us a higher yield than corporate bonds do. And it varies, but anywhere from sort of 40 to 80 bips over corporate bonds is where you were seeing life company debt pricing. But what we're seeing is corporate bonds, they're becoming, a lot of companies are over levered, they're being downgraded, they're riskier assets. And so the pricing for those has gone up. And so in relation, so have life companies. And so a number of life companies have pulled just sort of off to the side to see where things go. They just don't really feel like it's worth them their time to put out money at that pricing for the risk that they're getting. Others still continue to lend, but we're seeing higher pricing because, again, they could just go out and buy corporate bonds and potentially take on similar risk today. So interesting side of the market, different, nuanced, but again, some of those lenders have pulled off completely, but some are still in the market and actively quoting and closing deals.
Interesting. Why did the CMBS market shut down?
So again, that's really fueled by liquidity at the end of the day. So we saw this in 2009 where it just fell off. We've seen it actually a few times since then where there have been sort of small short-term credit crunches just within the economy. And so CMBS, like mortgage-backed securities, Fannie and Freddie, ultimately someone has to buy that paper in the secondary market because these lenders, what they're doing is they're putting loans out, aggregating them into pools, and then securitizing them by selling off those bonds on the secondary market to get them off their balance sheet. And so if the risk is too great and there's no bond buyers willing to take that risk or have the capital willing to place that risk, then no one's willing to buy those. And so now what you have is essentially sort of the back end stopping the front end, because these lenders are saying, no one's willing to buy this. We're not willing to keep it on our balance sheet. So we're just not going to issue new loans until that market comes back. And so interestingly enough, as part of, I think, the last round of the stimulus, we talked about how the Fed is now buying mortgage-backed securities for Fannie Mae specifically. They've also said that they will at least buy legacy CMBS paper. So some of those securitizations that didn't happen and these loans that are still on CMBS lenders' books, they should be able to hopefully move those off as the Fed buys some of those. But again, just because they're moving off their balance sheet, I don't think that means they're going to start issuing new loans just yet.
I'm seeing some paper come through from those loans right now where people are willing to take discounts on that paper in order to get it off their books because of that liquidity. So what you're saying right now primarily is that the liquidity from the market is primarily given by the Fed right now. They're the only buyers of the bonds at this time, is what you're seeing?
No, I wouldn't say that. So let me talk about Fannie specifically, because I think that's where we do the most business. So you have the Fed, and the Fed is only buying one type of paper. It's 10-year fixed with 9.5 years of yield maintenance. It's very sort of cookie cutter loans. They're good assets, good leverage, good underwriting, obviously, because it's Fannie. And so they're buying one type. So that's helping that market and giving sort of premium pricing. The other, say, 5 bond buyers in that market, including Fannie Mae as one of them, they're still in that market. And so they're buying maybe the 7-year fixed or maybe the full term IO deals. And so what you're seeing is those are going to have a slight premium, 15, 20, 30 basis points over your typical 10-year fixed, 2 to 3 years standard IO type of deals, because they're buying it, not the Fed. So there's still liquidity in that market, but you're actually seeing sort of a separation of who wants the A paper and who's willing to take the triple B paper.
Interesting.
Makes sense.
Matt, what are you seeing with the loans that you're involved with?
It's interesting. I'm mostly in the Midwest with the financing we do, and I've seen a major uptick in not only the amount of paper, but the quality for us. People are willing to put a little bit more money down, and it's mostly because a lot of the flippers right now want that a little bit of extra room in that deal, and they want to be more conservative and not use a little bit less leverage and things like that. So we're seeing more quality buyers. We're using a little bit less leverage, and I think we're around 65% loan to value on a lot of these. We're requiring, I don't care what they buy it for, even if it's less than 65, we're requiring 10% down on purchase and rehab no matter what. And so it's really even lowering our leverage even further from there. And we're dealing with a lot of properties in the Midwest that have pretty decent cap rates. So if we had to foreclose, so it's not horrible from that standpoint. We are making sure, hey, you got a little bit more reserves. I've seen so many people just leave the market completely. There's still people that'll do, 90% of purchase and 100% of rehab up to 75% loan to value. But it's rare. And I think a lot of the other lenders in these markets have backed off a lot. And what happened was a lot of the people with the private money are still around. A lot of the people that had warehouse lines and things like that, it's tough because, a lot of those lines are getting pulled back or they're getting more stringent and they have a lot less flexibility than the private capital sources. And so that automatically takes out a lot of hard money lenders out of the market just from that scenario. So I don't know, Dave, I don't know if you agree on the hard money lending side with me or not, or if you're seeing the same thing in California. It's obviously a totally different market than the Midwest, of course. So I'm very curious to see what you're seeing too.
Yeah, let's go to Dave Weiner. What's going on in your space?
Very interesting. I think I hear a lot of talk about efficient markets and the breakdown of efficient markets. In our space, the markets aren't as efficient. It's a crude flow of capital relative to some of these other markets. So, when you look at what's going on in our space, I would say just separating what's going on with the other lenders out there. There's a few that are still putting capital out. There's some that are just talking about it and going day to day and adjusting their terms. And then a lot of them have either paused or are in trouble and they're already starting to scramble. I think I'm a little bit more pessimistic about the market, or we'll talk in that tone, because in the position that we're in, I manage a fund, and as I'm a fiduciary for my investors, we need to look at planning for the worst. Okay, so a big part of the space and our thought is what if this happens? Obviously, or of course, we're hoping for the best, but we really need to position ourselves for a downside scenario. And in doing that, we've made a choice to put a pause on lending. I'd say that across the board, what each lender is doing probably tracks to their values and their beliefs in what's going on in the marketplace, and their values as to what's driving them. For us, we've built our reputation. We're very focused on working with our borrowers and helping them succeed. So to do that, we need to have liquidity and we need to have staying power so that we can treat our borrowers the way we want to treat them. If we used all of our resources to continue making loans in an environment like this, it would leave us thinner and we wouldn't have the opportunity to be as flexible as we want to be. It's the space that we're in. It's 90% value add lending. We do bridge loans, but not a lot. So most of what we're lending on is a project that's going to add value, and it's hard to get my arms around lending on a value add property when we're probably in a declining market. Those two things don't work well together. So you got to wonder why certain lenders are still putting money out, and it could be because of their beliefs. They don't think that we're headed into a worsening recession, and it could be because their motives are different, and what's important to them is generating income. And with every loan, you earn some fees. Most likely, those lenders aren't holding on to those loans; they're putting them off on somebody else, whether it's fractionalizing to some smaller investors, or if there is any, still selling them off in sort of this Wall Street secondary market. So you have to look at those, and I'll tell you, I've had some conversations with some of my peers, and you get different answers as to why they're doing what they're doing. And in those conversations, I'm learning that if you don't care about what your borrower, if you're ready to file an NOD the day your borrower misses a payment, then there's a reason. There's a reason for that. You're either, all you care about is making the money on the fees, or maybe you're in the position that you don't mind owning properties that go the wrong way. So anyway, if we're heading into a market that's declining, I think what I need to do is look at my borrower. We've always said that our number one criteria for making loans is that our borrower is going to make money. So what are the factors that our borrowers should be looking at? And when we have conversations with our borrowers about, hey, should they be doing this deal in the first place? The factors that they need to look at relate to, the kinds of loans that Brett's doing and on the takeout side. Are you going to be able to sell that home in 6 months from now? Is the lender, our borrowers going to have jobs or have the confidence to buy a home at the price that you think it is now, or really what it was a month ago? Are you going to be able to get a lender, as the buyer, going to be able to get a lender to lend them the money? And if it's on terms that are acceptable. So there's a lot of wild cards there. And one thing that doesn't work in our space is time holding it longer. You don't have a lot of flexibility, or our borrowers don't have a lot of flexibility. the way they come into these projects, time is probably their biggest enemy, because the rates are higher, because risks are higher on these types of projects. So we really, when we talk to our borrowers and we try to help them as much as we can, our conversations in this market, at least with this period of time where things are so uncertain, is, you know what, maybe it's time to take a pause. Maybe the project you're looking at now is coming from your viewpoint a month ago. Look forward a little bit, look beyond the dynamics of the market right now, and see what you're getting yourself into.
Makes sense. Andrew, you had something to add?
Yeah, I wanted to just piggyback on something that Matt said, and I think it'll tie into what David's just said too. Part of what we're seeing of people who are in and out of the market is you have to understand where the capital is coming from. And so, going back to CMBS, ultimately the capital is coming from the bond buyers, right? The folks who are buying that paper after the fact, which is no longer there. We've seen in the CLO market, which is sort of the securitized bridge space that a lot of these similar lenders were doing also, that's dried up as well, right? Because again, it's the same function, but a lot of those folks are also leveraging warehouse lines, like Matt said. So those have either been called during, there was a liquidity crunch, and so they no longer have the ability to even put that money out. But we are seeing folks who are smartly levered, unlevered, who are still active in these markets. And that goes for CLO bridge lending, that goes for hard money. At the end of the day, cash is king, right? So if you're unlevered, you may have a different viewpoint of the world today, because you're willing to maybe take on some risks and fill a void that you may not have been able to win in the past, as long as you maybe generate some yield. So I think that's a kind of interesting nuance to go along with what David said, that again, these folks, they may have a different perspective of where we're going to be 3, 6, 12 months from now, but some of them may also have, unlike a mortgage REIT, they have to worry about their stock price that's tanking. They may have cash in the bank that they need to put out and make a yield on.
Right.
I agree with Dave as well on that. The protection of the borrower is everything. Going into any new flip now, I'm basically going out and saying, look, you get counterbalancing this and saying this might go down by 10, 15, 20%. And where are you going to be at? Are you going to be at a break even there? And then we hold back 6 months of interest across the board to make sure that they have those extra funds. And we also talk to them in the Midwest. It's easier to do alternative exit strategies through seller financing and those types of strategies to get your dollar figure if need to. I show them how to structure those. California is a different market that's tougher because the monthly payment costs so much money out here with these higher priced houses. And I think it's a more volatile market. So Dave, I think you're doing the right thing by taking a step back and, taking a look at this and in this market to see what's going to happen, because California was super heated, right? I mean, I think looking at it though, California still is going to have demand as long as there's jobs there, at the end of the day.
Well, okay. And I'm glad you said that, because as long as there's jobs there, jobs are traditionally the leading indicator of the housing market.
Right.
And I believe last count was about 25% unemployment all of a sudden. I know that's temporary, but how much of it is temporary?
Right.
And we just don't know. And so to jump in and again, I'm talking more in my space, that to jump in to this market, it's something to be cautious about. We're sitting on a lot of cash, and I have a fiduciary responsibility to the investors in the fund to generate returns for that cash. But first and foremost is capital preservation. And for the group that we have, the investors that we have, they're happy to take lower returns for a while, as long as their capital is going to be preserved.
So what are you looking for in the market before you start lending again?
That's a great question. We're asking ourselves that every single day. I think I want to see some stability. I mean, look, because this does also create an opportunity. We could go, when we got into this lending space in 2010, we were lending, and our borrowers were happy to get access to money at 12% and 4 points. Well, going into this, we're fighting it at 8 and 1, 8 and 1.5, with a whole lot of new competitors. Could we come back right now and start going lower loan to value, higher interest rates, higher points. Yeah, we could. There's demand for that, and that's what some of the other lenders are doing. I don't like the prospects though, because whatever loan you make right now, your borrower has to make payments, and I don't like the dynamics and the prospects of sitting with a portfolio of borrowers who are struggling to make their payments. That's not the business we want to be in. So it's day to day. When we see that there's some predictability in what's going on and we can price appropriately, we may come out with a product that does a limited amount of business with certain types of borrowers that can weather the storm. But our borrowers typically not that kind of borrower. Our borrowers typically going into loans, into deals with very little of their own money. They're usually borrowing from us, and then they may have a private investor, a gap financer that funds a good portion, if not all the rest. So that, again, it's not a good formula for this market. And I'd rather stay true to our core lending and our customers, and build a bond through this period rather than, tear it all up and start over with something new.
That could be good thinking. Okay, so let's talk briefly. We touched on this during the introductions, but let's talk about underwriting and qualification standards, just maybe quickly and specifically in each of your niches. So David Guevara, what are we seeing right now? What's changed with underwriting and qualification standards?
Yeah, in the past, as long as the cash flows from the properties, the net operating income of the property supported, 70 to 75% loan to value. Here in this local market, we could offer 70 to 75% loan to value on purchase, rate and term refis, and cash out refis for the local portfolio banks that are lending on their own deposits. And then, typically we were seeing anywhere between 1.15 to 1.25 debt coverage ratio, usually around 1.15 to 1.2. Now what we're seeing is a lot of 1.2 to 2.25 debt coverage ratio. So essentially what that means is, your monthly net operating income needs to be, 20 to 25% more than your monthly principal and interest payment. And then, aside from that, we're seeing maximum loan to values drop from 75 down to 70, increase of minimum debt coverage ratio, and then asking for additional reserves. Those are the main ones. Certain banks have increased their underwriting rates, which is essentially the stress rate that I was talking about earlier, where maybe your note rate is 4.25, but they're underwriting it now at 5% to come up with your final loan amount. In general, it's just hard to push anything. Before, it was, hey, this is a strong deal, strong borrower. Let's push it. We can get, a little bit higher loan amount. We can, let's get the rate a little bit lower. Now, nobody's really looking to push on the bank side. Everybody's kind of trying to stay in that conservative, comfortable area for the time being. And in the meantime, banks are, looking at this as an opportunity to, especially the banks that are lending on their own deposits, to lower their own cost of funds. They're looking at they're looking at the treasuries and the Fed funds rate, and they're saying, hey, maybe we don't need to offer that savings account at 1.75% interest. Maybe we can offer it at 1.25%, 1%, 0.85, and we can lower our own cost of funds so that when we come out of this, we're in a better position to lend and potentially make a little more money on these deals. So, it's definitely, banks are looking at it conservatively for the time being, but they're also looking at it, in the long run to see how they can position themselves to come back stronger and potentially lend more.
It's an attractive proposition right now, for those of us that have property, maybe with some equity in them, to try and do a refi, get as much cash as we can, right, and sit around and wait for opportunities. Do you see banks treating cash out refis different than they are with purchases or rate and term refis?
Absolutely. Cash out refinances are I guess, looked at as the highest risk right now, because they don't want people taking on additional leverage, especially higher payments, especially in a time where your rents are less guaranteed than before. So cash out refinances, even though it may provide additional liquidity, banks understand people are not necessarily going to sit on that money. They're going to go turn around and invest it. And they know that that doesn't necessarily turn into, liquidity that you're going to maintain. So they're definitely looking at cash out refinances with a lot more conservative lens. Purchase transactions there's still plenty of debt available at 75% for purchase transactions that supplies sufficient cash flow to support it. But cash out refinances, you're looking at, certain lenders aren't offering it at all. Certain ones are capping it at 50% loan to value. Others are capping it, up to 70, but still those are the most aggressive. It's next to impossible to get cash out refinance from a portfolio bank right now in excess of 70 LTV.
Got it. And I know interest only was actually pretty widespread and popular up until we went into this thing. Is that gone?
For now, the agencies are still offering interest only. A lot of the portfolio banks are not. Again, it's just a more conservative way to look at it. The banks, they want to know that the principal is getting reduced, and for them, that's what's making them more comfortable. So for the time being, it definitely interest only has become a lot more difficult.
Got it. So Brett, what's changed in underwriting and qualifying standards in your area?
On investment properties, if somebody's buying a property and they're going to live in a unit, maybe it's a 3 or 4 unit, and rent out the other few, we're not going to give them the income from the other units to qualify any longer, temporarily, I should say, unless they meet the reserve requirement. If they have reserve requirement, we're going back to the old rule. We'll give them 75% of rents to qualify. If they don't have enough reserves and they're using all the money to buy the property, they have to qualify for the entire property and not use any of the income to offset their qualifying. So that's a big one.
Yeah.
So as I mentioned before, some reserve requirements on certain programs. One of the things that maybe David and Andrew can emphasize on, I had about 6 apartment loans in the process. A couple of them were new construction, fully stabilized properties in the middle of their refining out of construction loans that are now sitting on hold. So these guys are sitting on construction loans and they're hitting them with 10% vacancy rates, even though they don't have any vacancy. So they always hit them with a 5% vacancy, but now the banks want to hit them with 10% vacancy, not to mention a higher stress rate. So qualifying on the apartments we've seen to be more difficult. I'll probably be sending some of those over to Andrew to see if they fit his agency box.
What about debt to income ratios? Have those changed?
No, actually only a tiny bit. Believe it or not, we used to go to 55% debt to income on FHA. They just lowered that. And again, I'm not a guideline whiz, but I think they lowered it to 49.9, which is it probably should have been all along.
What kind of reserves? What kind of reserves are you looking at?
You could still buy, 1 to 4 units with 3.5% down. It's pretty impressive.
Wow.
With record low rates.
What kind of reserves are you looking at right now in order to qualify? What are you seeing change there compared to previous?
There was no reserve requirement before on a 1 to 2 unit FHA. So you could buy a property with 3.5% down. You could have $0 in the bank. You could have a bank statement that has 0. 100% could be a gift, and you could close with no reserves. Now you have to have, I believe it's 2-month reserves. Again, I don't want to go beyond the guideline. I don't follow them that closely, but I believe now you actually have to have a month or 2 of reserve.
Wow.
So they ratchet up a little, but it's still pretty aggressive.
Yeah.
And you wonder why a lot of people are asking for forbearance right now with this stuff, so, and what about, you had mentioned previously that a lot of, all the non-QM lenders, a big chunk of them are gone now. What's your thoughts as far as, have you talked to any of them as far as, are they just on pause? Is that market completely gone forever? Or do you think it might be coming back afterwards? What is just your opinion based on your discussions with these guys?
Maybe explain for those that don't know what non-QM means too.
When financial reform came out after the Great Recession, they put loans into 2 boxes, qualified mortgages and non-qualified mortgages. And the idea of a qualified mortgage was that after the mortgage meltdown of 2008-9, everybody was losing their home and suing their lender. And the lenders couldn't handle the influx of lawsuits. So they created this safe harbor that if a lender wrote a loan that fit inside a certain box, box and you checked off all of those boxes, you fall into a safe harbor called a qualified mortgage. It couldn't be interest only, can't be negative amortizing. It had to be primary residence. So there's this whole, like a checklist. If it didn't fit that checklist, you can still do them, but you no longer get the safe harbor of the United States government. Generally, you're higher risk. So non-QM would be, I'll give you an example of some of ours. You could have filed a bankruptcy last month. As long as you still qualify from an income standpoint, we'll lend to you. So you could have a really low credit score and a bankruptcy. You could have past foreclosures. Those are the kind of non-QM programs we offer. We had 5% down to $2 million. We had 10% down to $3 million with shoddy credit, by the way. You know, it used to be called subprime. They don't call it that.
That's what I was going to say.
The answer to your question is, if you come back, I don't know. A lot of the reason why it left was because the secondary market that was they were bundling these loans and selling them dried up. In our company's case, it's a little bit different. We actually are owned by a hedge fund that wants these loans on the book. So we have the appetite for them. But because the secondary market dried up, because everybody else left the market, we left the market too. Kind of a herd mentality. Will it come back? Yeah, I think it'll come back. Like everything comes back. You know, the only thing that never came back was the negative amortizing loans.
Thank God.
They were about to.
They were probably, right? Stated income didn't exactly come back on an owner-occupied, but they invented the bank statement loan program. All right, I'm not going to show you my tax returns, but here's 12 months bank statements. You can see I make money, and that was the new version. That was stated income 2.0.
All right, Andrew Westling. So what's changed with underwriting qualifications in your space?
Sure. So, you know, there's not a ton.
Oh, the feed cut out.
I think we lost him.
That's a great screenshot of them, by the way.
Let's go to Dave.
Underwriting qualifications. Like David said, yes.
You're back?
It cut out for a minute there.
Why don't you start over with your response, Andrew?
No worries. Yeah, let me know if it's better.
Okay. All good now.
Beautiful. Sorry about that. So as David said, you know, we're not seeing a ton of changes per se. We're seeing some additional covenants and restrictions being put on. Maybe cash out is probably the one we're seeing more scrutinized, whereas before on refinances, we'd go to 75% LTV down to a 125 cover with Fannie and Freddie. Now it's probably 70 and a 130, right? So they're just limiting max leverage that you can take out. But that said, you know, things, you know, again, cash out, it's still not a dirty word. IO is still getting done with Fannie and Freddie. But on every loan they're doing, except for Fannie Tier 4, there are additional reserve requirements. And those range from 6 to 18 months of principal and interest payments, and then 6 months of taxes and insurance and rollover reserves. And that 6 to 18 month depends on both the size of your loan and also the leverage point. So Fannie prices in 3 different tiers. There's Tier 2, which is the highest leverage, then Tier 3, and then Tier 4, Tier 4 being the lowest leverage. Again, those have no additional reserve requirements. So that's business as usual. It's still their best pricing, their top tier. But again, to qualify, that property has to be both below 55% LTV and above a 155 debt service amortizing. So those are stringent, you know, that's high quality, low leverage financing. As you go up the scale and up the leverage, you see that those additional reserve requirements get more stringent and more stringent. And then as you go lower on the loan amount, the smaller the loan amount, the more stringent they're being as well. And so when we look at our Fannie program, we actually have 2. We have our small balance Fannie, which starts at $1.5 million up to about $7.5 million. And then we have our regular Fannie program, which starts at $7.5 million, but they're probably willing to go down to about 5 or 6 and goes up from there. And so what we found historically is that smaller loans are typically more a higher probability of default and potential foreclosure. And so that's why you're seeing more and more restrictions on smaller loan amounts. On the life company space, it's pretty much business as usual for the folks that are still quoting, except for, again, they're adding in required P&I reserves on almost every asset class. And then again, CMBS is it's a no-go right now. It's a no-fly zone.
Got it. All right, thank you. Matt, you talked a little bit about reserves already in the loans that you're looking at. Are you doing anything additional to underwrite deals right now?
I'm just making sure, like I said, they have the reserves, that I'm padding their rehab bids and things like that, and having them pad for that extra, having them expect an extra 3 to 4 months of potential delays on the construction side and stuff like that, just to be on the safe side, even though it may only be an extra month or two. But, it's harder to get inspections done. It's harder to get appraisals done. It's, the lenders are tightening up. So they need to understand and be educated across the board on all of that stuff. So I'm putting a ton of time into education across the board with these borrowers so that they understand how to mitigate their risks, and showing them, they need to get better deals right now in order to make sure they're comfortable and not going to lose their money. Because, like Dave said, that's the most important thing. I don't want this property back. I don't want to deal with the headache of, it's always 10 times more work if you ever have to take a property back than if you just perform, then you can keep making money with that person over and over and over again, which is the whole idea, So anything you can do to bring them for success. I showed them, I gave a video to all of them on how to actually apply for the SBA payroll loans and the disaster loans as well, to try to help them increase their liquidity. I made sure I knew the exactly where we were on every project, and exactly where that timeline was going to end for when they were going to go to market as well, so that they could understand where they're at, So I'm also showing them alternative exit strategies, either through the turnkey space that I work in as well, selling the properties rented as well, or, refinancing, in different ways too, showing them it may still work on a financing side, and doing the math for them on those calculations so they can see all their exits.
Got it. And Dave Weiner, I know you're not making new loans right now. Have you talked to other hard money and bridge lenders here in California about what they're doing to underwrite deals in this environment?
Yeah, I was going to jokingly say, we don't do anything on underwriting. We're just focusing on asset management. But the underwriting that's going on, and we are trying to keep our finger on the pulse of that. The easy things to talk about are, using a lower loan to value, whether that's just quoting a lower loan to value, which may be the case with lenders with the most integrity, but some are still quoting the same, 80%, 90% of ARV, but then when they go and look at your ARV, they're gonna take a bite out of it there. So effectively, it's the same thing.
Right.
You may be looking at requirements for reserves, prepaid interest. Maybe it's 3 or 6 months of prepaid interest. Most of these loans are interest only, so they'll require that. Personal guarantees are probably becoming more popular. They were becoming non-existent there for a while, but I think they're coming back. And it probably, depends on which type of loans you're talking about. Flip loans, they're probably not underwriting the extensive flips. With major structural issues, those may be tougher. With permits, those may be tougher. I mean, you've got planning departments in Northern California that are just shut down. And then you have, if you're planning on doing construction or renovations, and right now, several counties, again, up north, have they're enforcing, and they're stopping in on these projects, and they're saying, hey, you have to stop, or it's going to be $1,000 fine a day, because workers are there and shouldn't be. So, the flips are tougher. Construction, probably very tough. And then bridge loans, those tend to be a little more popular right now. There's no cash out refis happening, I'll tell you that.
Yeah. All right. Andrew, you had something to add?
Anthony, if I could just add one thing, it's not really a new guideline or new underwriting piece, but sort of to echo what David said, in both agency financing and life company financing, we're seeing that the lenders are were really sticking to their guidelines, meaning minimum net worth requirements, minimum post-closing liquidity requirements, and really not faltering from there. Whereas before you might have said, this is an existing borrower, we've done business with them, we know them, whatever it may be. There's extenuating circumstances. Now they're saying, we really need to check all of those boxes before we can proceed with a loan. So that's kind of interesting to see how they're not sort of shutting off the spigot, but they're being a little bit more selective. Whereas before, I think it was before everything hit, it was you can negotiate, right? You can make an argument and sort of win favors here and there.
Got it. Okay, so let's talk about a huge topic right now that's going around, forbearance. So, there's all these headlines out there. Everybody's thinking, oh, you don't have to pay the rent. You don't have to pay your mortgage, all this, right? So what is going on with forbearance and the lenders that all of you are working with? How are those requests being processed, handled? Are they being granted? How are the workouts being structured? Are they adding it to the end of the loan? Do you owe it right away after this is over? Is there a payment period? Is it a loan modification? Does it hit your credit? And what's the deal with that? Should people be doing that? Is it a terrible idea? And what's going to be the impact of that on the industry? We'll start with David Guevara.
Okay, yeah. So it's been kind of interesting. I think a lot of the reactions that the banks are having has been a result of so many forbearance requests that immediately they figured, oh shoot, we might not be getting a lot of the payments that we were expecting, and so we need to keep liquidity. Again, like Andrew was talking about before, liquidity is so important. So they need to maintain liquidity, and then so the way that they're handling a lot of forbearance requests right now is it's different across the board. So some banks are being very generous with it and saying, hey, if you need it, let us know. We'll offer forbearance, and we're not going to look at it negatively in the future for future loan applications. But new loans that were originated in the last couple of months and we recently verified liquidity, we're not offering it on those ones. That's something that's very common as well. Other banks that are particularly the smaller banks with less resources are being a lot less forgiving. They're requiring the payments. They're saying, hey, we underwrote you with a certain amount of reserves. We underwrote you with a debt coverage ratio. And in many cases, we stress the rate. And, we did your loan 3-4 years ago with normal increases. You should be able to have, 85, 90% economic occupancy and still be able to pay this without problem. And if you don't, then you have your reserve. So it's all over the board. It's really tough to say, but some banks are being more forgiving than others. And the way a lot of it is structured is some of them are adding the payments again on the end of the fixed period, and some of them are, they're giving a certain timeline to make those payments, a forgiveness period, or not a forgiveness, but a payment period.
Got it. And Brett, how about the residential lenders? What's happening with forbearance there?
It's different on the type of who's servicing. Caliber is a large loan servicer. We have about $150 billion of loan servicing, and I've heard crazy numbers on the amount of forbearance. All you have to do is request it. You do not have to. You do not have to prove that you've been laid off. You don't have to prove financial hardship. Nothing coronavirus related. All you do is make one phone call, and you can get up to 90 days of forbearance. The way we're currently handling it is it's all due and payable on the 90th day.
Oh wow.
People aren't happy about it, but could it change? I think when the time comes and we know what happens and the economy opens and people go back to work, maybe they'll tack it onto the back end. Maybe they'll give them 12-month repayment. I don't know. I strongly encourage all of my clients who've asked me about what our forbearance is not to take advantage of it. So that it's not free. You're going to pay it back one way or another. Yep. And I echo what David said. All my apartment owners that I've done loans for, I got them all of the different forbearance and deferment and interest-only options that the lenders are offering, and I was able to provide all in writing with a giant caveat. Don't do it. We wrote you this loan, you had significant assets, you have tremendous cash flow. And not only that, in 6 months from now, you want to take cash out and go buy more buildings, you're not going to get a loan.
Right.
Lenders are going to see that you're taking advantage of it. So now you have enough money to go buy loans, but you couldn't make the payments 3 months ago. I don't understand.
I think
So
that's
if you have to do it, if you are unemployed and you have no reserves,
Right.
forbearance is for you. Forbearance or deferment, do it. It's not going to affect credit. It's not going to have penalties. And that's what the program is for. If you don't need it, don't take advantage of it.
yeah.
By the way, it's caused another big hiccup in lending, by the way, because these servicers, their servicing values have gone down so much because there's no valuation in servicing. Profitability for lenders underwriting loans that they service, profitability matrix has changed. And until 2 days ago, they were giving homeowners the relief of not making their payments. But they were giving agencies, but they weren't giving servicers. So these servicers, like a company like us, we have $150 billion in loan servicing, and we still have to make the principal and interest payments every month. They're not giving us forbearance. So every month we have to pay the investors their return. We have zero forbearance. So the government jumped in to help the property owners and backstop the banks, but they didn't do anything to help servicers.
Yeah, I was going to ask if you think there's a systemic risk here because of the widespread use of forbearance when maybe it shouldn't be used.
There is risk. I can't tell you much about it, but they released yesterday a bit of a backstop for servicers. So that'll help.
All right, Andrew Westling, what's going on with this forbearance topic in your area?
Sure. And for the record, the National Association of Realtors, National Multifamily Council, and NBA have all been lobbying for servicer relief. So hopefully, hopefully it does not fall on deaf ears.
Yeah.
So we have about $100 billion servicing portfolio, most of which is Fannie and Freddie loans that we've originated in HUD loans, but also our life company. So we have other asset classes in there. But we've actually seen a very small percentage of our portfolio actually request forbearance. Collections have been very good, and I think surprisingly good so far through April. It'll be interesting to see what happens in May. But thankfully we have not had to really focus on that. And our asset management team has done a great job looking at that. On the life company side, we're seeing particularly hospitality has been extremely hard hit. So any loans out there from hospitality, a majority of them, 70 plus, if not 90+%, I think are requesting forbearance because their income, of course, went to zero, especially with the travel ban, et cetera. Retail, we're seeing, it depends, right? It kind of depends on, even within the sector in retail, as grocery stores are gangbusters and open right now. Pharmacy is doing well. Up until the oil crisis, C-stores and gas stations were doing great. Medical office is doing quite well, but restaurants and bars and salons and other things like that. So it really depends on the makeup of the property. Gyms, obviously. So we're seeing it throughout across the board. Fannie and Freddie were very proactive in forbearance. They came out and essentially streamlined what the guidelines are, so you can get 1, 2, 3 months forbearance. So long as you abide by the CARES Act, which means you cannot evict or start the foreclosure process on anyone during that time, and then you must repay and bring the loan current within 12 months of the end of forbearance. So very streamlined, very sort of methodical. The life companies, it's more of a discussion. It depends on the asset. I find that they are very logical and full of reason. So if you can show them and bring your documentation and say, listen, here's the list of my tenants that aren't paying or are paying reduced, and here's how we try to mitigate it. We've applied for the EIDL. We've applied to PPP. They're being really understanding about it because we're in this together. Lenders, borrowers, servicers, everyone's feeling the pain right now, and it shouldn't be punished. As from what I'm hearing, if you get a loan mod due to COVID, it will not be registered against you for, say, the next time you go to apply for a loan, that you have to say it is, so long as you state that it's for COVID, especially in CMBS world, that's always a big stigma of getting that loan modification is going to hurt your eligibility on future loans. So we're hearing that from servicers that might not be the case. But again, it's across the board. The CMBS industry is absolutely inundated with requests for forbearance, just because, again, they fund so many hospitality and retail properties that have been affected, that they're feeling the brunt of this, I think, more than anyone in the industry.
Right. And so Matt and Dave, I assume then in the hard money space, is this even a thing, or is this just case by case, negotiate, see how the deal goes?
Yeah, no, for us, it's definitely case by case. There's so many factors that we consider when looking at a deferral or forbearance. There's no requirement come down from the state or from the agencies or anything that applies to us. So there is some early on, there were some misconceptions and some requests that came in based upon, hey, I have a right to this, but no, that's not the case. And then, I'll talk broader than us for a second. How lenders treat this probably has a lot to do with how they're structured. If a lender is, a fund lender and they're earning fees and being able to support themselves based upon a percentage of assets, they might have the ability and a tendency to be a little more lenient and flexible with borrowers and be able to do some deferrals or forbearance. However, if you're doing loans and selling them off to our secondary market players, it's usually done with a spread. Or if you're the type of lender that's just fractionalizing interest with a bunch of small investors, you make your money on a spread, and that spread only comes if the borrower pays their interest.
Right.
So with that kind of lender, you're going to see a lot less flexibility. There's also another interesting, I'm trying to show you, our listeners, what's behind the scenes here and what might be motivating your lender if you're having these discussions with them. A lot of lenders with funds or other types that have, warehouse, whether it's a borrowing-based line of credit or a warehouse line of credit, they might be motivated by factors with their lender. So, for instance, a fund might have a borrowing base that you pledge assets on the line, you get some liquidity, and you can go lend that out again. Well, once that project is on the line, that loan's on the line, you might have a 60-day period of, if a borrower goes 60 days delinquent, you have to take it off the line. So here you are talking about, a couple $1,000 a deferral, what's the big deal? But in actuality, if the lender extends beyond that 60 days or whatever it is with their particular terms, they're looking at, having to come up with $300,000, $400,000, $500,000 to pull that off the line. It's basically like a margin call. So there's probably a lot of friction and a lot to do with the health of the lender or the desires of the lender, whether or not you're going to be able to get that kind of treatment. For us, the way we're managing it is what's most important to us, our highest priority, is moving the project forward. So if a deferral becomes part of a plan and a strategy to move the project and get it finished, that's a win-win for us and for our borrowers. So that's generally how we approach it. But there's so many variables, whether it's the condition of the borrower's portfolio, our portfolio, the project status, the project condition. All those things come into play uniquely with every call. And so, we sit down when we get a request and we just look at the factors associated with that loan. And, we have about 100 million in loans out right now that we're managing. And so you can imagine we're spending a lot of time on the asset management side.
Right.
It's a good thing we don't have to do a lot of underwriting right now.
Makes sense. Matt, have you had any of those requests in your book?
I had one person ask if that's even a possibility, and I said, no, that doesn't apply to commercial lending. So But you know, in reality, we hold 90% of our loans. We hold 6 months of interest anyways. So it's really just a matter of making sure, like Dave's saying, that project is moving on forward on a timeline, you know. And from the other side of things, though, we do a lot of turnkey sales to investors, and have you know, we've sold over 700 houses to investors in the Midwest that are all holding rentals. And you know, when this all came out, it sounded like a great idea to go do forbearance for 3 months just in case the tenants don't pay, because they scare the crap out of you. The media does, of course, and everyone's thinking not a single tenant's going to pay, and how am I going to pay these mortgages? And at the end of the day, so far for April, we're looking at like the very, very similar, maybe 5 to 10% max variation in collections. It has not been major across the board on our tenant base, at least on the single family home or apartment tenant base. But you know, May 6th, the date that it's due, you know, late, is going to be telling for sure to see if it's going to decrease. I do think if people get especially in the Midwest, if they start getting the $1,200 checks and things like that in the mail, that's enough to pay your rent in many places in the Midwest. And so, you know, we've taken steps across the board for that. And then I'm seeing things come out, and Brett, maybe you can shed some light to this as well, to where, you know, from a servicing perspective, the lenders are willing to go through and give 3 months and say, no problem, here's your 3 months. But I'm hearing rumblings from different real estate investors and things like that saying, you know, the servicers don't really know they can't report it negative on your credit, but they're still putting comments on your credit saying, you know, this is now in forbearance, which then if it gets run again later, like you were mentioning, there's a big red flag for a comment in someone's credit report. I don't know how. This is a couple of instances that investors brought up. I don't know if it's, you know, just those instances that people are seeing, or if this is rampant across the board from a servicing perspective to actually go and make those comments, and which then makes you very scared of, hey, did an investor just screw themselves because now they can't qualify for another year because they had this, you know, comment on there that it's in forbearance.
I'll make a quick comment on that. And as the way I understand it is, they're saying it's not going to affect your credit. They're not going to pay any penalties or any late fees. However, I saw that happen in 2009. And then what happened was, a couple years later, those people turned those forbearances. They had to repay them. How did they repay them? They did a loan modification. The loan modification then reported on their credit report, although it was never late, it was never delinquent. They have a loan mod, and a loan modification goes into the same category as a foreclosure, a late. They're frowned upon very heavily in lending. The other thing is, it could be a red flag. If somebody just took their loan, you know, they took $1 million loan out 3 months ago, and they go 3 months into forbearance, they might owe more on their loan that they did when they started. So you can see on the credit report that their loan went up, and we know we don't have negative amortizing loans other than loans that are in forbearance. So it's kind of it could be obvious that they were in forbearance. And another thing, what if we ask for 12-month payment history on their loan? You know, try to prove that one.
That's a tough one.
So I think it is going to. I think it could negatively affect people when they didn't intend on it. So I urge you not to go into forbearance unless you have to.
Very good points.
And cooperate with your lender. Do it by the book. Do it however they tell you to do it, and don't deviate.
Yeah, good idea. So Matt shared a little bit about his experience as an owner out of state. I can say as a multifamily owner here locally, I have a sizable portfolio in the LA area, and I have the same experience. Collections now at the end of April, I think only about 8% delinquent as compared to a normal month where we're 5% delinquent anyway. So far it's been very light. Everybody is waiting to see what's going to happen in May. And I think it's going to be really telling, because maybe the impact of this stuff has been delayed and people had enough money to make the April rent. On the other hand, people have also had enough time to get the unemployment checks starting to come in. So we're all hoping that some of these stimulus measures, the checks from the government, are going to allow people to pay rent, and that it's going to just all trickle upstream and we won't need to ask. But on the topic of not paying the mortgage, what is everyone's opinion on where this might go? Are we going to see foreclosures again in a significant measure and all of the market implications that come with that. And I'll just toss it out to whoever wants to comment on that.
Well, I'm going to jump on that one. I remember in 2008, 9, 10, when we saw massive numbers of foreclosures, one of the biggest problems was it wasn't so much that the home went down in value. It's that they bought a home. I'll use Las Vegas was a great example because values went down well in excess of 50%. Someone paid $800,000 for the house. They might have put 0 down or 5% down. Their house drops to $500,000. They probably could still afford it. The problem is, and a lot of the reasons why people bailed on their homes, was they were sitting on rates in this 5, 6, and 7%. They had terrible loans. And their neighbors would buy the exact home next door for $400,000 less, half the price, and get a 3.5% rate. So they're like, I'm not going to pay $800 on my house. I'm paying 6.5. My neighbor just bought the exact house for half the price and got a 3.5, and people were walking. People have quality. We have quality borrowers and quality loans. Are we going to see foreclosures? Absolutely. I just think that hopefully jobs is the underlying factor that we don't know the answer to. If jobs come back they're not going to go back to where they were. But if jobs come back, I think people will keep their homes. I think apartments, on the apartment side, if some of these rental groups that just keep bashing these homeowners and telling them not to pay their rent,
Yeah.
in this battle, apartment owners are going to lose. But apartments should be fine. People, if you can't afford your rent, the apartment owners are going to have a blemish of not having rent for 3, 6, 9 months, however long it is to get people out, but eventually get qualified renters in that.
That's a good point, because probably what's going to be happening is people may delay the sale to get this off of that last 12 months of rent rolls on multifamilies and things like that to get that pricing to where it needs to be on the back end sale. It's definitely a concern, and I personally don't think that the employment's going to jump back all of a sudden or anything like that. We're going to have, it may jump back a degree from where it's at right now. I think it'll get a little bit worse before it gets better. But I think it'll jump back a little bit as the economy opens up. But at the same time, looking at, restaurants and the hospitality industries and, a lot, and even the event industries that we were dealing with and throwing events. I mean, everything changes, at least for a period of time. I mean, we probably won't go back to live events for months at this point, because who's going to go to a live event and be around a bunch of other people for at least a period of time until people realize, hey, I'm safe now, right? And I think that's going to occur across the board. I don't know about you guys. I want to go support local restaurants, but I don't want to go in a super crowded restaurant. And I don't know when you guys, I mean, I got kids now. I'm not going to a bar anyways.
With a mask on too.
So yeah, exactly. What are you going to go to a bar with a mask on, or go to a restaurant with a mask on and eat? Yeah. So I feel like it's going to take some time to get back to where we were, and it's going to be a trickle out. And I still think this is exposing the underlying problems with the overall economy as it was in the first place, and showing that, hey, people are broke and they don't have a month or 2 months to live off of. And this is a big problem in America and the world. And a lot of it came from getting cheap debt and having that availability there with tons of credit cards and tons of things like that. And we may see some contraction of the availability of that, which I personally think might be a good thing for people in the long run. And in the long run, I think this is going to change people's mindsets to realize, wow, I can't live for 2 months. And so therefore, they might tighten the belt a little bit on these things. And, we might see some contraction and some deflation before we see some massive inflation down the line because of the printing and everything. But I could be totally wrong. I'm just trying to be logical about what's happening here and seeing what I see out there. But I don't know if you guys agree or disagree or have different thoughts about what may occur.
Yeah, one thing I've noticed is just from some of the clients I work with, and then just talking with a lot of the local banks that I work with as well. As much as the unemployment impacts rents, and rents directly impact property owners, it's going to have to persist for a little while, for quite a while longer, before this turns into an issue of mass foreclosures on multifamily properties, especially in the smaller space, because even though property owners have a reputation for being dirt rich and cash poor, right now there's quite a bit of reserves out there, and then there's also not as high of leverage as there has been in previous times. Typically, people in this local market are anywhere between 40 to 65% leverage, I would say, on average. There's quite a few that are on the higher side of that, but even at 65% leverage, you're looking at a humongous decline in value before it even makes sense to try to walk away from it. And then, so I think the foreclosures that are going to be out there are going to not be strategic foreclosures. It's going to be genuinely out of desperation, which lowers that number significantly.
Right. Makes sense. Andrew, what do you think?
Yeah, I mean, listen, we're a big multifamily shop. So we are bullish on multifamily. We think the underlying fundamentals in Southern California, being that there's still a housing shortage, people need a place to live, that when we come out of this, it will still be probably the strongest sector. It's funny, with all of this, we've seen A-class apartments actually really thriving with the least amount of collection loss, because most of those tenants are more white collar, work from home, whereas B and C class apartments are usually catering to more blue collar hourly workers who need to go and are working somewhere and maybe either been laid off or furloughed. But I think it's asset class specific. The big question is, how many local restaurants and nail salons are not going to weather this storm, and those jobs are going to be lost, because you're not going to get a brand new one coming in overnight. That's going to take time to replace. And so you're going to have lower cash flow, probably lower NOIs for a little while as things sort of revert back to normal. But like Matt said, when is the time where things are fully functional again? And I think that's probably post-vaccine, and not just post-vaccine, but post-widespread use of the vaccine, which could be, who knows from now. So it'll be slow. I know we're hearing CEOs pushing for a V-shaped recovery or a U-shaped recovery. I'm probably more of a Nike swoosh guy. I think it'll be a little bit slower. I do think things might get a little bit worse in May and June before they start to get better. It'll be interesting to see what the impact of what the stimulus has been. Matt was spot on. This could really tighten things down. We might see deflation. With our GDP, depending on how much we lose and how quickly we regain it, I don't know if we'll see inflation, just because $2 trillion is input to our economy. It's so large. That may actually just be what we needed to sort of keep current status and keep the status quo going. So overall, I'm bullish on real estate. I think comparatively, you look at corporate debt, it's become much riskier. Downgrades have happened. I think there's yield to be had. And I think where interest rates are and will continue to be, real estate will be one of the few places that people can continue to find yield. And so I think you'll still see investment into the sector.
Dave, where do you see this going?
Well, you're not going to see a lot of foreclosures coming from Trillion Capital. I'm predicting that. But no, I'll talk about kind of three positive factors, three negative factors. I think a big thing is the condition of real estate markets, the housing markets coming into this. I felt like we were really strong, and it's because, credit's been somewhat responsible for a while now since the last downturn. So there is more equity. We don't have the subprime kind of condition that we had before. So credit was still fairly tight. Unless you had a really good job or documentation, you couldn't get a loan. Supply's we've been undersupplied, and I'm speaking primarily from a California and coastal California perspective, but supply's been constrained for quite some time. And an interesting thing that I perceive about the residential the housing market that was a result of the last downturn was we kind of have a safety net now that's been built in. A whole new asset class on Wall Street was invented, which is single family rentals. And so I believe there is an infrastructure in place and a lot of capital in place that if, single family values drop to a certain point, it becomes desirable for these Wall Street funds and hedge funds to come in and buy them, and then they turn them into REITs, and we have a whole new asset class for that. So I think the conditions that we saw in the last downturn don't exist this time, and we had a lot of a barrier for that happening. I think another good thing is affordability. I mean, wow, interest rates like this, that's a strong force to help housing values and keep momentum going, or at least protect it on the downside. And then, that's driven by, really the third factor is how aggressive, the Fed and government action is to prevent this from happening. And, they're throwing everything at it. It's unprecedented. So that's all amazing. So those things I think are working for us. There's three factors I think that to talk about that working against the housing market. The first one is jobs. The second one is jobs, and the third one is jobs. I mean, look at what's happening with this, current, like I said, 25% unemployment today.
Right.
We can be optimistic and say, okay, a few weeks from now, open up the gates and everybody goes back to work. But everybody's going back to work with less confidence in their job, less money in their pocket. Businesses, like Andrew said, that there's going to be a lot of businesses that just can't make it through this. I mean, we're still locked up. It's been over a month, and I don't know. I don't have a date yet where we're going out and able to go get our haircut. I've already done 2 myself. So sorry about that. But so you can look at that and you can say, the last downturn was the fault of the real estate dynamics in the real estate market, and we got slammed, and we took the rest of the country with us, right?
Right.
This time, I think real estate is sort of sitting there as a beacon of strength, but everything's crumbling around us, and everything about real estate is dependent upon those factors. So, we've got every single person, every single sector, every single market, not just in this country, but across the world. This is a big deal. And I don't know if all those, let's see what happens, what's going to win out. But I think, if I were to predict what's going to happen, we're going to see some downside and a struggling market to recover. And I think it could last a long time, not months, but a year or more before things really kick in and start building strong again. We're positioning ourselves. We were born in a market where we're helping, the housing market and Americans build again, right? So we're going to thrive in that environment. I can't wait to get there. And I hope it's a month from now. But I think it's going to be a little bit tougher, a little longer haul than a lot of people are planning for or expecting.
Yeah, I agree 100%. I think it's going to take some time to come back. And that was an awesome scenario, synopsis on the strength of the market, but also the dangers out there that are coming. We could very well see 50% unemployment or something like that if this lasts longer, which would be absolutely, it would be the most devastating thing ever. But you look at what could happen, and we're in uncharted territories. None of us really know what's going on or what may get us out of this. And, we're listening to the news and everything and trying to figure it out and look at the economics, but you're right on the money. I don't know that we'll go there, but at the same time, this could be 2-3 years down a downward, spiral.
Another interesting analogy I heard was that the economy is sort of in a medically induced coma.
Right.
This was called for. This is controlled, and we're all, a part of that and understanding it. But we've never been in one of these before, and we don't know when we wake up from this, what's going to happen with our organs and how the heart gets pumping again, and what other things might be happening. So this is going to be, from a stand back objective point, this is a fascinating time, and we'll see how it plays out.
That's a great analogy. I'm going to have to use that one. So kind of on that topic of guessing where, the market's going to go, what do we think, obviously for people to get back to work and to have some good news on the health front is the most important thing here. But once we start to, kind of be on the outward trajectory from this thing, what do we expect to see from the lending environment? When do we start to go back to normal? What is it going to look like when we do? Are rates going to be in the twos? Is this just going to be an absolute bonanza? Are we still going to see this widened risk premium going forward for a while? And then what do you think as we go on 2 to 3 years out? Are we going to have crazy inflation and way higher interest rates? Or what do you got? I know this is, impossible question to answer, obviously, but I'm interested to hear what you guys think are going to happen both near term and longer term once we're through the worst of the health crisis here.
Yeah, I'll get started on that one. I think, from the perspective of the majority of the loans I do, which are small multifamily portfolio loans, once banks are comfortable that rents are going to be collected and their own internal data from their own portfolio loans that they're looking at looks not so bleak, they're going to start moving and getting more aggressive. Banks make money by lending, and so they want to continue to make money. I don't think that they flipped the switch back down like they did flipping it. I think it's going to be a slower process, but let's say May collections don't look too bad. June collections are looking stronger. People start to go back to work. The overall outlook is looking positive. I think banks start to come back into the market and over the summer slowly drop their rates and slowly loosen up their criteria. And sometime in the fall, October, November maybe, we start to see things normalize back to where they were. I know before this, a lot of the local banks I work with, they were at a rate of 3.4, 3.5% on 5-year money. And they were saying we really can't go much lower than this, even if the Fed rate goes to 0, which it hadn't yet. They said we're not going to chase it down, or the treasuries. We can't chase it down to 0 because our own internal cost of funds is too high that we can't support that. So if I don't see rates, maybe Andrew will be able to offer rates in the 2s, but I don't think that local banks are going to be able to support loans much lower than the 3 to 3.5% rate.
Okay. So before I toss it over to Andrew real quick to respond, since he got mentioned, for those attendees here, this will be our last prepared question, but we still have some time left. So if you have some questions, feel free to use the chat. I see that we have a couple in the Q&A as well. And then once we're done with this question, we'll get to your questions. So go ahead, Andrew.
Thanks. I think Fannie and Freddie and HUD are really well positioned for a prolonged downturn. I think we saw it in sort of the Great Recession, whatever we're calling it. But starting in 2009, once Fannie and Freddie were put under conservatorship and were funded, really by the government and really became quasi-government agencies, they continue to lend throughout the downturn. I think we'll see that through this one. They're already in, basically in the pocket of the Fed at this point. And so, again, there's buyers for the paper. It's high quality paper. It's well underwritten paper. It's fairly low leverage paper on a quality asset class, probably sort of the shining star within the industry. So I think rates, it kind of depends how long the Fed keeps buying Fannie MBS, if you keep getting this super premium pricing. But Matt and I have joked for the last 8 years that the Fed was going to stop QE, right? And they've kept going, right? So when they're invested in something and they want to continue it, that may continue. And so we may see this, really sort of pull through and become a good source of high quality capital, despite what you may be hearing in other sectors within real estate in general.
All right. Brett, what do you think?
I don't think any of us have any idea, to be honest with you. I think we're in the business of lending.
Right.
So we're always going to be lending. I think it's going to always be changing. Whatever this recession looks like, it is a world recession. It's not a real estate recession. It's not a financial recession. This has nothing to do with the underlying assets being bad or the underlying loans being bad, like David mentioned. This is because of a health pandemic. But I can tell you this, when it comes to real estate, I owned investment real estate before the last financial meltdown, and I weathered that storm, and it was a bit painful. And every one of my assets came out on the other side of that storm far more valuable than it was before the storm. So if you own real estate assets, weather it. And the other thing that's been my experience and kind of a commonly known thing, if you look at people that have built a significant amount of wealth in their life, whether they're high income earners or low income earners, they've built their wealth in many cases through real estate. There's sudden wealth. You can win the lottery, you can have an inheritance or sell a company. But a lot of wealth building is long-term holdings of real estate. And I just encourage it, and I think that don't buy high and sell low. Don't sell when the storm is bad. Weather it out, and you come out better on the other side. I can't speak about other markets because some other markets didn't come back, and who knows this time. I know Southern California.
Good advice. What do you think, Dave? When does
I have a short answer for that. It's prepare for the worst and hope for the best. So I think liquidity, staying power is important. If you keep some dry powder, if you can maybe liquidate something now that you're losing some of your upside, but it gives you staying power and allows you to be there later if the opportunities arise. I think then that wouldn't be a bad strategy.
All right. Matt, you want to weigh in on where you think lending's going short term and longer?
Well, I just, the economy, and it really depends on the economy in general. And in reality, just based on the amount of money printing, like what Brett's saying, holding this stuff long term, granted, we might have some initial deflation if you can weather it through that and get cash flow crunch that may come in certain assets. But if you keep your eyes open and focus on the opportunity, there's going to be a lot of opportunity to be holding things for the long term when that inflation does kick in and trickles into the market after the initial deflationary period, because they're printing so much. And I personally think they're probably not going to stop QE ever at this point, because they're now buying bonds, they're buying corporate stock and things like that. And, they're getting into a whole nother ball game here. And so from that perspective, I think the long-term inflation aspect of holding long-term real estate is going to be better. It's going to actually, you're going to gain a lot of wealth through that long-term. Short-term, nobody knows. Like what Brett's saying, we don't really know. We're just seeing the charts, and hopefully we're professionally guessing as best we can based on what we're seeing and what everybody else is doing. So don't get me wrong, I'm really happy being my introvert self and staying at home and never talking to anybody. It's great. You get a lot of work done, but at the same time, it's going to be very hard to predict. But I do think that long term, we're going to see some inflation happen. It's very difficult, like what Robert Fragoso was saying on one of our previous classes here, was that it's not easy to have inflation when oil prices are -40 like the other day. It's absolutely, it's really difficult. But I think when we get back to a normal oil market and that money starts to trickle in and they continue the QE, I think that we'll see that. Now, could there be other factors that I'm not seeing that could give inflationary or deflationary pressures? Of course, but I'm just talking the long-term aspect of that.
Got it. All right.
And just to add one more thing, every panel I've been on over the last, call it 5 years, I've tried to work this in some matter of fact. And it's hard to do in a rising market because everyone gets, carried away with values and leverage. But this really shows the value of using leverage wisely and not over leveraging. And as you're looking at long-term assets, how important it is, how important amortization is, and that it's your friend. And that cash flow is great, and we all love it, and it makes the world go round. But so are, building equity and building enough to weather these types of storms so that you can come through on the other end and kickstart that cash flow again. So
great advice. Great advice. So I'm going to turn it over to the questions now. We have a few in the Q&A. Attendees can feel free to put it in the chat or there as well if you have others. So the first one's from Clarissa. I own a lease option and the tenant is now late 2 months. What's the best way to handle this situation? My servicer tells me that they don't qualify for deferment.
She's selling a property and the buyer has the, is the tenant
Owns a
without the
lease,
buyer?
owns a lease option, and the tenant's now late 2 months.
Oh.
They need to work with them until, because they probably won't be able to evict them anyways right now. Normally it would be an eviction situation if they're not paying, but they should be working with them in this situation. And what we're doing on the, it's just like on any other rental. They don't own the property yet, you know, unless there's a land contract in place or something. Even a land contract, you can basically evict like a tenant in most states, depending on, or in some, I'll say some, the states that I deal with, you can evict like a, you know, just like a normal renter, but you want to be careful and try to keep them in as best you can and work with them to try to work through this situation. Just like any landlord, you know, on the commercial space or residential space, you don't want to just kick them out because of a situation like this. Put it on the back end, put a payment plan in place, see what they can pay now, if anything, see if they help them go get the loans from, you know, the SBA and different, you know, payroll loans or whatever they can do to help apply their security deposit towards it first, then catch up, you know, those types of things to work with them, because you don't want them moving out. You don't want to have more rents that, you know, you can't collect because you have a turnover afterwards. And, you know, the courts are going to be behind, you know, months now because of a couple month delay. They're going to be behind, you know, 6 months because they're already inefficient and behind. And so if that's the case, you really want to work and do everything you can to keep them in and not have to go the eviction route.
Yeah.
It's hard to tell what the questioner's mindset is. Are they concerned that they're not getting income? Are they concerned how to treat the purchase option? It sounds to me like you can't really count on this tenant being a purchaser of your property. If they can't make the rent, so it'll be a long time before they can get a mortgage. So, you know, just you're looking at your prospects of treating them like a tenant. I'm sure your lease option has some kind of clause that says if they don't make their lease option payments, they're not entitled to the option anymore anyway. So I'm not sure if the question is how to work with them or how to get rid of them so they can get somebody in who's paying rent.
Yeah.
And either way, I would just recommend to document it all throughout this time, because when you come out of this, no matter which way you want it to proceed, you want to make sure that you have all the information and the support to either potentially maybe evict that tenant or to you know, come to some agreement or a contract where they repay you, if not putting a contract in front of them now saying, listen, it's okay that you're late now, but we need to make sure I'm repaid within X amount of time frame.
Yeah. Great point. Okay, I'm going to go to the next question. This one's anonymous. How are the banks factoring in local, state, and federal renter protection policies during underwriting? Has anybody seen any difference on that?
Yeah, a lot of that has to do with the reserves that they're requiring. So most of the changes in the local, state, and federal rent protections are short term, and they're for the next 6 to 12 months. And so that's the banks are essentially making up for that by collecting 6 to 12 months payments up front, or holding them in a reserve account and releasing them when things normalize. So that's mainly what I've seen.
Makes sense.
Yeah.
And then from Phil, is anyone seeing significant drops in appraised values for residential multifamily in LA or SoCal? I can answer this one from a little bit of personal experience, unfortunately. I was just going through a refinance, actually with David, and not his fault. But the appraisal came in on a building I was trying to do cash out, and the appraiser cited a declining market, despite this is a great building, totally stabilized, great rents. And this building is in a decent area in Long Beach, not far from downtown. And they brought it in at $100,000 below what it appraised for 3 years ago, after I stabilized it at something like an actual cap rate. What was it, like above? It was above 7 or something like that, right?
Yeah, it was an insane cap rate. And what I've seen,
Sell it?
I would never sell it for that price. I'm just going to keep the existing financing and I'll hang out. Yeah, it's still cash flowing. So yeah.
Yeah, I've seen, me personally, and I'm sure everybody has gotten different answers, but I've seen some appraisals come in absolutely normal. And I've seen some come in extremely low. So I think it's an appraiser by appraiser scenario where some appraisers look at the market and they say, this is not the same market as the comparables that we're looking at, or the previous history of cap rates that we're looking at. So we can't use that information. And other appraisers say, until the market adjusts, I'm not adjusting the way I appraise. So yeah, I mean, as far as the sales, Anthony, you're probably the best to ask if there's been actually any changes in the sales. But from what I've seen from apartments, it's been all over the place. Some are coming in, nothing's really appraising high. Some are coming in at value, and some are coming in under.
Yeah, as far as the market, what the market's doing right now, I think I didn't actually introduce myself at the beginning of this panel, but I'm a local multifamily broker, so I see these things day in and day out. Right now, the market has not adjusted at all. New listings are going on at same cap rates, same price per door, same GRM as they were 2 months ago. I think you have some sellers that are thinking they're going to sell high and buy low, and somebody's going to come along and do that. But and inventory hasn't really shot up. It's starting to go up a little bit, but not a lot. There still are some deals going on. And some of that is 1031 exchange money, looking for a place to park. There's significant tax consequences for people that don't buy those. That being said, on a case-by-case basis, I have experienced the ability to negotiate more effectively on those deals that are already on the market at like what was a normal price a couple months ago. Now, it's really obvious that sellers are not getting the action that they were. Listing brokers are not getting the same activity. The same listing brokers that we're working with all the time that, 2 years ago, it would have had multiple offers and, not looking to, make your life easy if you're wanting to cooperate with them, are now reaching out to us. We do a lot of buyer rep in our area, and they're saying, what do you got? You guys got buyers? Like, we have listings, we can do some deals. Here's what we have. And no, the list prices haven't adjusted. But, if you're in the market right now, I think there is an opportunity to go buy something and find a building that you'd like to own and negotiate on that. I've had some success in a couple different cases, working deals out that would have been absolutely impossible only weeks ago. So that's what I'm seeing in the market, but you won't see that if you crack LoopNet, CoStar, MLS open. It doesn't look like anything has changed yet, and it's going to take a few months for the market to adjust and for sellers and appraisals to adjust with it. The frustrating thing is, like what happened to us on this refi, is the comps are absolutely there for, this property is worth about 2.4 million, and the appraisal came in at 2,075,000, the one I was trying to refi. So totally killed the refi, didn't do it. But so they're just deciding that they're in a declining market. Never mind that there's no support for that. The sales comps aren't there. So, and we may continue to see more of that just because they know that a lot of transactions have stopped. There's definitely been some cancellations, and we just don't really know what's going to happen. So it kind of remains to be seen. But from the broker's perspective, there has not been an impact of values yet on a widespread basis.
I think on the lending side of things, that's what will affect the values. If the last crash that occurred when there was no liquidity in the market on the single family home side, there was a massive reduction in pricing because there was no appraisals for a period of time. There was a bunch of cash closings, or a lot less appraisals happening. And so I think that will happen again where, lenders are tightening standards. So then therefore less sales, less purchases may happen because of that. You may have appraisals getting you stiffed like what just happened here, where they're not justifying it based on the data. They're just based on the feeling here. And I think that's going to continue to a degree throughout this process and through the next 6 to 8 months, or at least. And it may affect pricing just from that angle alone, from the lending side, because things are tightening and you're just going to see it happen. It's going to be more difficult. You're going to have more headaches, more appraisal disputes, and all that fun stuff to deal with again.
Yeah.
I want to add one thing.
It's interesting with appraisals. If you go back a couple of real estate cycles ago, with the savings and loan crisis, that's when FIREA was brought about, and appraisers were blamed a lot for that downturn. Sorry, my battery here. Were blamed for that downturn because they were taking into account the trend in the market in the up times. So they're saying, all right, well, you know, the dynamics of the residential market are so strong, we're going to appraise values up here because that's where it's going. And they were right for a long time, and it was right for them to do that because that's part of value. And you don't just look in the rearview mirror, you look to where things are going and determining values today based on that movement. Well, they got slapped when values fell, and everybody blamed the appraisers for inflating prices and getting ahead of where they actually were. So now this is, you know, on this part of the cycle, you have the opposite effect. Now that appraisers have been told, just look at historical data, you have no basis for looking beyond that. You know, I would find it very difficult to be appraising a property right now and not make an assumption that values are lower today than the comp I'm looking at 3 months ago or 2 months ago or even 1 month ago. So it's a very sticky time right now where lenders are going into new transactions based upon old values that are basically ignoring what's going on. I was about to make a personal purchase, and I was actually arguing with the bank, trying to get them to lower the appraisal because of conditions, and there were a couple other things too. They wouldn't have anything to do with it. They were stuck on that value. The appraiser came in, and that, you know, that's final. So it's going to be an interesting thing to see how it works against appraisers again this time, where they're continuing to be sticky and not able to you know, measure the trend in their analysis.
When there is evidence of declining values in the local Southern California markets, and then the appraisers have to comment on it, they will add. I'm surprised that the appraiser did that because he's looking forward. He wasn't looking into. There are
well, it wasn't necessarily the hard evidence to
right.
To
And once that happens, though, the underwriting guidelines will change. Right now, I think the lenders on the multifamily are just stressing it because it's not going to, shouldn't necessarily reflect on the appraisal. So instead, what they're doing is stressing with a higher qualifying rate, a higher debt service rate, and a higher vacancy rate. So
right, which is what they should do.
yeah.
Right.
There are Northern California markets, by the way, that have evidence right now. And I don't know if it's Santa Rosa or San Francisco up in that area that are now having appraisals the appraisers are coming in saying a declining market pre-coronavirus, by the way. And so in those markets, some of our lenders are hitting the LTVs 5 and 10% lower because of the appraiser comments.
Wow. Uncharted territories indeed, at least for the last 10 years or so.
Yeah.
All right, well, that's it for the questions that we have in the Q&A and the comments. We are just about at 2 hours. So thank you for all of our attendees for sticking with us late at night, hopefully comfortable in your own homes, safe and healthy. And thank you so much to our panelists. I think this has been a great discussion. I certainly learned a lot tonight, and I'm really looking forward to seeing what happens in the future. Thanks so much for joining us. We will see you next month.
Thank you, Anthony.
Thanks for having me.
Thanks for hosting, Anthony and Matt. Great to see everybody.
Yeah,
Thanks,
have a
guys.
good one.
Stay healthy.
Yes.
Yes.